Hello, I'm Nathan Kubik, and thank you for joining us for the fourth quarter of 2018 Carnegie and Kubik Capital Markets Outlook. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. Despite the meaningful momentum experienced in the third quarter, the markets experienced a significant level of volatility in the last quarter of 2018. This period of volatility came as a result of heightened investor emotions and a myriad of items in the news. The primary items include rising interest rates, trade wars, government shutdown, Brexit, Italy, and France. The S&P ended the year being down about 4.5%. However, from the peak to market trough, the S&P 500 was down 19.5% from the high. The market did rally back a bit in the final week of the year, and that rally has continued into 2019. While there were certainly market influencing factors at play, we believe that in the final quarter of 2018, we witnessed a dichotomy between financial market sentiment and that of actual financial data. Towards the end of the year and into the new year, we have benefited from some positive news items. The Fed Chairman, Jerome Powell, has indicated that the Fed will be patient, which is something that the markets were excited to hear. The central bank believes that the U.S. economy is growing and is strong enough to withstand higher interest rates. GDP for the third quarter showed that the U.S. economy grew at a pace of 3.4%. Employment numbers continue to look strong, U.S. earnings continue to grow, and the U.S. dollar appears to have stabilized, and company fundamentals do look attractive. The trade war continues to be a key area of focus. Discussions here are underway, but outcomes are yet unknown. This is a factor that has the potential to be a meaningful positive or negative in 2019. Following the record low volatility experienced through 2017, we did experience relatively high levels of volatility in 2018. This chart allows us to visualize some of the past market cycles. From this chart, it should be apparent that we've dipped back to the general trend line of the most recent market expansion cycle. While volatility and market momentum are important factors that must be incorporated into a comprehensive investment strategy, they by themselves should not be the primary drivers of that investment strategy. Looking back in history, we can see many similar levels of volatility and the corresponding corrections. Not all of these past periods of volatility have resulted in as large a correction as the one we just experienced, but this chart should paint the picture of the volatility that is inherent in the equity markets. The size of this correction was likely exacerbated by the long leading up period of low volatility. Also, the high levels of market exposures through index strategies and the ever-growing derivative marketplace. In looking at volatility as a forecasting tool, it could be considered a lagging indicator, as it actually is the result of investor actions. That said, there is always the possibility that it plays a role in influencing a self-fulfilling prophecy. Put simply, if non-fundamental data and emotion are driving the markets, it is possible for individuals to shift their spending and consumption patterns. This in turn does have the ability to change corporate revenues and earnings and shift the economic and fundamental data. With the exception of department stores, which have their own struggles, we are yet to see indications of this being the case. Additionally, financial market confidence appears to be shifting, which further dampens the likelihood of this risk. Economic indicators continue to look positive. Sentiment levels are high, unemployment levels are at record lows, and job market competition has begun to move the dial on wage growth. Within the retail sales bucket, the trend towards e-commerce has continued and total retail sales have continued to climb. That's not to say there aren't areas that are struggling, but as a whole, it is continuing to drive higher. Going back to our self-fulfilling prophecy discussion, retail sales will continue to be a critical indicator in need of monitoring, but so far it appears to be continuing its positive trend. Household wealth continues to move higher while household debt service remains at low levels. Moving into 2019, we expect to see economic data return to driving the financial markets, and that company fundamentals will also become a primary focus when valuing equity prices. The correction has resulted in equities devaluing to a point that should be considered undervalued on a historical basis. 1 year ago, forward price to earnings ratios reached an 18.2 multiple. This was an overvalued level that made sense when impending corporate tax cuts were priced in. Upon tax reform implementation, multiples returned to a normative level. However, after this correction, multiples have diminished to only a 14.4 multiple versus its long-term average of 16.1 times. Simply moving back to the long-term average would result in a 12% increase to the S&P 500. Additionally, the consensus of analysts project the S&P 500 earnings to grow at an additional 8% rate in 2019. While there are always risks that can shift a market cycle, the current market valuations are disconnected from fundamentals and the consensus of expectations. The story about market devaluations is true throughout the world. All too often, we focus on the S&P 500 as a barometer for the equity markets. We do this because most investors recognize this index. That said, the S&P 500 is not the entire world's equity market. The S&P 500 does not represent the US small or mid-cap marketplace, nor does it represent the rest of the developed world or the emerging markets. These are all areas that are considered in our equity strategies, but these are areas that we have seen relative weakness when compared to the domestic markets. As you can see, the rest of the world fared far worse in 2018 than that of the US. The chart on the right shows the total return of each region denoted by the black diamonds. It also shows us some of the contributing attributes of that return in those bars. The ACWI ex-US is an index that shows us the rest of the world's performance after excluding the United States. As you can see, for 2018, the ACWI index was down 13.8% compared with the US being down 4.4%. The blue shows us that the US was able to increase its earnings per share in a much more meaningful way than the rest of the world, and that is the primary reason for the near 10% difference in total return for 2018. In addition to the deviation in performance between domestic and international, there is also a meaningful difference within the domestic markets between different types of style investing. In the fourth quarter, there was a flight towards safety. With this shift, we saw an outperformance in companies that are larger, have stronger fundamentals, and have greater degrees of inelasticity in demand for their products or services. Thus, in the fourth quarter, we saw large cap companies outperform small cap companies by a meaningful amount. Additionally, we saw large value companies gain an edge over large growth companies. However, for 2018 as a whole, growth companies outperform value companies by a significant amount, and that trend appears to be resurfacing as we move into 2019. Recognizing the performance and volatility deviations within the different investment styles, we made some tactical style shifts this past quarter in our core equity model. Specifically, we moved out of that small cap exposure and moved it to large cap, with a bit more emphasis of the move to large cap value. Fundamentally, we believe the long-term trend to remain tilted towards large cap growth. However, we did move toward a more neutral large cap style positioning as the markets work through the emotionality in the markets. We have already discussed our belief that the markets are attractively valued at the moment, but we wanted to share a bit more from a style perspective. Looking at the bottom part of this chart, we can see the current price to earnings as a percentage of the 20-year historical average. Each style is interesting in its own right, but let's look at the large cap growth as an example. At the end of the last quarter, the price to earnings was about 8% greater than the historical average. At the end of the fourth quarter, it was more than 10% lower than that average. This, when combined with the increased earnings, is a primary reason that we believe large cap growth will continue to look attractive. Obviously, if earnings growth begins to wane, then we will dramatically change this expectation. But to date, things appear to be continuing on a growth-oriented trajectory. A similar story can be seen within sectors. As you may expect, there was a meaningful disparity in performance from sector to sector, and even more so from subsector to subsector. Healthcare and industrials were the two top performing sectors, and materials and energy were the two worst performing sectors in 2018. Prior to the fourth quarter, the top performing sectors were discretionaries, technology, and healthcare. Healthcare was able to hold its spot towards the top, but the other two growth-oriented sectors were punished in the fourth quarter. Going into 2019, those same sectors appear to be recovering more quickly than the rest of the markets. Actual fourth quarter earnings within each sector will be the primary driver for what happens next within each of these sectors. While our style allocation has shifted within our core equity model, our sector over and underweights remain similar to that of last quarter. The sector overlay was a net benefit for our core model over all of 2018, but it did result in a bit of a give back in the final quarter of the year. It is our expectation that prior sector leadership will resurface moving into 2019. From a historical valuation standpoint, most sectors have become more attractive, and when coupled with expected earnings growth, we feel strongly about our current positionings. Our overweights remain with technology, healthcare, financials, and discretionaries, and we remain underweight in utilities, real estate, and materials. While financials lagged in 2018, we are maintaining this overweight with the expectation of an eventual steepening of the yield curve. Our sector overlay for the dividend model also remains similar to that of the previous quarter. Due to this model's focus on increased stability and an already inherent tilt towards large value, there was not a need for any meaningful tactical shifts. Sector and style overlays remain strategic, and we will continue our focus on strong fundamentals and dividend growth. For all of our equity models, should we see economic data shift or earnings growths begin to slow, we will be making a number of tactical shifts, and sector weightings will be foremost among those shifts. As we discussed last quarter, the Federal Reserve has increased the short end of the yield curve by raising the Fed funds rate. This is the overnight bank borrowing rate, which influences bond prices and yields, making up the entire yield curve. Interestingly, the equity market volatility and the corresponding flight to safety has resulted in an incredibly flat yield curve. In fact, there is even a slight inversion around the 1-year mark. Other sovereign debt yields have dropped a bit as well, further reflecting the flight to safety. This flat yield curve has some implications, but we would argue that the short-term inversion comes as a result of a deviation between the Fed funds forecasts and market expectations. Interestingly, the flatness of the Treasury curve does not translate into all types of bonds. Yields as a whole did increase, which has an impact on the present value of a bond. Municipal, mortgage-backed, and Treasury bonds all had a positive year, coming as a result of their coupon payments offsetting the change to the present value. Looking at the chart on the bottom, we can see each bond class's total returns. Corporate bond values were down 2.5% for 2018, which is meaningfully more than that of other bonds. This implies a greater increase in their corporate yields, which we can see in the top chart. It is interesting to note that for both the corporate and municipal bond curves, there are more normative upward sloping curves than that of treasuries. Generally, most bond yields spread off the treasury bond curve, which isn't necessarily the case right now. So the question becomes, why is the treasury curve so much flatter than that of other bond curves? And why the slight inversion at the 1-year mark? The answer is that the markets are pricing in significantly different expectations than the projections set forth by the FOMC. In considering this slide, the dotted blue line shows us where the FOMC has indicated they expect rates to be in future years. The dotted burgundy line reflects where the market believes rates will be. Do you notice how the market expectation rates are the same as the Treasury yield curve from the previous slide? This is because the markets have priced in the expectation of limited further rate hikes, whereas the Fed says 2 more are coming. Ultimately, what happens next is dependent on a myriad of factors affecting the economy and the Fed's ultimate decision as to what to do with that information. So we will need to wait and see which expectation is correct. The piece of information that gives us comfort as we wait to see what happens next in the economy is the Fed's recent commentary that they will be patient with monetary policy and are willing to pause on rate hikes if needed. In conclusion, given all available indicators and economic data, we feel cautiously optimistic about what 2019 looks like. We feel strongly about the companies we currently own and the way that we are positioned going into the new year. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking with you soon.